So, like I said, Tax Cut and Jobs Act created these, and they did it in order to incentivize money to go into areas that had historically been underinvested. And they said, listen, we want to take money out of the traditional markets and we want to put them into these areas. And so they said, listen, if you got a capital gain from like appreciated stock or appreciated real estate, you can harvest that capital gain or crypto or a business or whatever kind of capital gain that generates long-term or short-term. You take that capital gain, you put it into a qualified opportunity fund, which is literally just an LLC taxed as a partnership. And you're able to then defer that gain until 2026. So that's the first benefit. If you got it in before 2019 or 2021, you would get a reduction of taxes when you paid them in 2026. So that was the second benefit, which is now gone away. But we think that it might come back via pending legislation that's out there. And then the third benefit, and this is the real kicker, is that you get a step up in basis to fair market value on your new investment after you've held your investment in the fund for 10 years.
Welcome to CRE Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network's CRE Radio. Thanks for joining us. My name is J. Darren Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide you their experience and insight to help you grow your real estate portfolio. Today's program is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Ashley Tison. Ashley is an attorney, a professional speaker, and a founder of Oz Pros, a full-service opportunity zone advisory firm. And in just a minute, we're going to speak with Ashley Tison about opportunity zones for real estate tax mitigation. But first, a quick reminder, if you like our show, CRE Radio, there are a couple things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you want to see how handsome our guests are, be sure to check out our YouTube channel. You can find us on YouTube at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Ashley Tison. Welcome to CRE Radio.
Thanks, Darren. It's an honor and a privilege to be here. Super stoked to be talking about commercial real estate and opportunity zones and how to mitigate risks, all kinds of it. It's awesome.
Awesome. Well, I'm glad you're excited. I'm excited, and glad you're here. Hey, before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Yeah, so I like to call myself a recovering attorney or a reformed attorney. I am still licensed, but I try to practice as little as possible because, man, I like to be in the game. I started out as a big firm litigator. After it had sufficiently sucked my soul, I broke out. And I actually started a impact investment company back in 2005 that we utilized to do real estate deals on our own, and that also started doing disaster mitigation consulting and kind of aggregate continuity planning for folks. And then I had a very crazy kind of journey through the downturn. So I went into commercial real estate, and I was a tenant in common syndicator. So we syndicated commercial real estate deals through a broker-dealer network where we sold like enclosed malls. We bought them by the gallon and sold them by the scoop to 1031 investors, and decided that that wasn't risky enough. So went and developed a golf course in the mountains of North Carolina. That was April of 2007. So let me tell you how that worked out. And went back to practicing law, built up an M&A firm, and then I actually ended up selling that firm because I saw how much money business owners were leaving on the table when they sold. and focused on trying to help them with their tax mitigation strategies and their succession planning, and really dialing it in relative to their purpose and their passions, and focusing on moving towards something instead of moving away from something. While I was doing that, I went to a CLE and I heard about the Tax Cut and Jobs Act. And the guy was like, and in 3 pages, they created these things called opportunity zones. And I ran him down in the hallway afterwards. And I was like, wait, that sounds like 1031 and private equity got married, which are 2 of my like main backgrounds. And he's like, and they had a beautiful baby named Opportunity Zones. And I said, I'm in. Let's pop up a website. Let's see what happens with this thing. And then bam, we had $75 million worth of cash looking for deals and 150 inbound leads. And I was like, wow, we're really onto something. Let's figure out how we can take what we had in the past. And I had created a software that allowed us to do Main Street level M&A activity. So I said, let's repurpose that for opportunity zones so that we could put this program in the hands of Main Street America business owners and real estate investors. So that's what we did. And since then, we've kind of become a full service firm where we help people start them. So the lion's share of what we do is we help people set up bespoke kind of captive opportunity funds. And we've set up over 1,000 of those opportunity zone entities. And then, as you can imagine, they've got some concerns about compliance. So we put together a kind of a mastermind for folks that want to do compliance together. We've got over 100 people in that, and we meet weekly. And then we created a bigger, kind of wider network of participants in our Osworks group community. And we've got over like 700 people that are in that. And it's been really cool to see how people are utilizing this in order to, to mitigate risk inside of their real estate deals, to get a better return on a tax adjusted basis, but then also to see how it's actually positively impacted these communities. And it's, executed on a lifetime vision of mine, which is to show people how they can do well by doing good. And that's what we're all about. That's our mission, is to do well by doing good. And we try to do so by making generational wealth creation and tax mitigation fun and meaningful. And, as you can well imagine, those terms are usually diametrically opposed. And we hopefully will be able to do that today. Show people how they can create generational wealth, save money on taxes, and make it fun.
No, I love it. I love the do well by doing good. That's a great one there. Well, that's a lot to unpack, and your experience, that's kind of deep and wide, as far as what you've done, but also in the real estate space and investment, and sounds like a complete, background for someone that's trying to help people in this. And so maybe to start with, just to revisit and explain to the listeners what the opportunity zones are.
Sure. So, like I said, Tax Cut and Jobs Act created these, and they did it in order to incentivize money to go into areas that had historically been underinvested. And they said, listen, we want to take money out of the traditional markets and we want to put them into these areas. And so they said, listen, if you got a capital gain from like appreciated stock or appreciated real estate, you can harvest that capital gain, or crypto or a business or whatever kind of capital gain that generates long-term or short-term. You take that capital gain, you put it into a qualified opportunity fund, which is literally just an LLC taxed as a partnership. And you're able to then defer that gain until 2026. So that's the first benefit. If you got it in before 2019 or 2021, you would get a reduction of taxes when you paid them in 2026. So that was the second benefit, which is now gone away. But we think that it might come back via pending legislation that's out there. And then the third benefit, and this is the real kicker, is that you get a step up in basis to fair market value on your new investment after you've held your investment in the fund for 10 years. And that's really significant because it not only eliminates capital gains, but it also eliminates depreciation recapture. And for your listeners, that depreciation play inside of real estate is a really powerful mechanism where you can do a cost segregation study, utilize that bonus depreciation to offset your income. And in a deal, you could typically get around 40% upfront in year one that you can carry forward. And a lot of times that's enough to offset your income for almost the course of the whole deal. But they understand that if you sell before the makers catches up, the modified accelerated cost recovery schedule, and in bonus depreciation assets, that's 5 years, typically 5 years. If you sell before that time, you have an experience of what's called depreciation recapture, and opportunity zones eliminate that. And so between the power of, not paying the 23.8% or whatever taxes are going to be in the future, and not paying that depreciation recapture, which is typically at your ordinary income rates, man, it really juices a deal. So without factoring in the depreciation recapture, on average, the opportunity zone benefit is a 3% IRR bump on a side-by-side deal, which, as you know, in real estate investing world, that's nirvana. 3%, right, with no additional risk or no other complications, just because you did it as an OZ deal. Wow. And then when you factor in the depreciation recapture elimination as well, it just goes up further than that.
So tell me on the dates you were mentioning there, the 19 when they started, 26 when the taxes are due.
Mm-hmm.
Um, if you hold it longer, are the tax benefits, are they ongoing, or is that just a matter of if you were to sell the 26 tax would come into play?
So that's a great question, Darren. So the 2026 tax is on your original gain. So like, let's say that you had
Okay.
$1 million of crypto where you had zero basis in it, and which is probably not likely, but let's just say that you did. So you have $1 million of capital gain. You would normally pay $238,000 next year. You put it into a fund, you get to defer that tax until December 31st, 2026. So number one, we get an interest-free loan from the government, right? Which is usually the other way around. Number two, it gives us runway for us to be able to do some really creative tax planning between now and 2026. We could put you into oil and gas plays. We could put you into solar plays that have extra tax credits and other kind of benefits. We can do a lot of different stuff. We could do bonus depreciation, cost seg studies, that kind of thing. You're going to pay the taxes on that original gain in 2027 because it's due December 31st, 2026. You pay that, and then your new investment continues to grow tax-free up until you ultimately sell that. And you have to hold it for 10 years, but the smart money is asking, how long, much further past 10 years, can I hold it? And the answer is 2047. So you can hold it all the way up to 2047 and get a step up in basis to fair market value. And you don't actually have to sell that to a third party. You could actually sell it to yourself and pick up that, that step up in basis. And that becomes really powerful.
It's almost like, there's a Roth component built in there where, the tax-free on the growth there. That was a thing that always caught my attention. Plus everything you mentioned about the depreciation recapture, because that to me seems to be kind of a, kick in the face when you do sell something, if you've held it for a long time. I know a lot of people that are kind of new to syndication and stuff have looked at it more from just a pure investment strategy as opposed to like a real estate hold,
Sure.
kind of get in and get out type of thing. But I think for anybody that's kind of more traditional real estate investor mindset, the tax benefits have been one of the leading reasons to do so,
Sure.
from the standpoint of the depreciation. And, again, if you've held it something for, more than 10 or 15 years, that can really kind of put a wrinkle in your plans if you don't, exit that properly or have a plan to avoid or defer those taxes.
Well, and a lot of folks will 1031 and they're just
Right.
like, and so they go about the 1031 without really looking at like what the downstream effect of that is, because what you're doing is you're stacking low basis with lots of gains, right? And you're basically just kicking that tax can down the road. And they're like, oh, well, I'm going to get a step up in basis at my death. The problem is you get a step up in basis at death. And people aren't talking about the fact that, like right now, the lifetime exemption amounts like almost $24 million for a married couple. That drops down to around 10 in 2025. And so if you've got a net worth that's anywhere approaching $10 million, if you're over $10 million, when you die, your estate is going to pay taxes at 40% of whatever amount you're over $10 million. And so that's the tax tail of the 1031 that a lot of people aren't talking about. They're not cognizant of, and they're not really paying attention to. That is taken out in the context of opportunity zones, because instead of, dealing with a low basis that you're pushing down the road, you're dealing with your basis and your taxes now. You're paying those. You're getting aggressive on how do you mitigate the taxes associated with that, and then you're completely growing that tax free. To your point, like a Roth. So I used to call it a super Roth IRA, because you're going in tax advantaged, it's growing tax free, and then you're going to exit it tax free on the back end. The other really significant part about an opportunity zone deal is that when we were talking about that lifetime exemption amount, instead of the value of being at fair market value at your death, what you factor in towards your lifetime exemption is the original amount that you put into the fund. And so effectively it becomes a poor man's irrevocable trust for freezing your estate value too. And so these are all just derivative benefits that just come from the concept of doing an OZ deal. And you can factor this into kind of your aggregate planning and utilize it as part of your strategy.
So let me ask you, you mentioned, in the beginning, the purpose of the opportunity zones was to attract capital from all areas, not just real estate kind of thing. As far as the real estate aspect goes, are you able to exchange in, like 1031 exchange into an opportunity zone, or because you, or go ahead.
You can't. So 1031 and the code section for opportunity zones is 1400Z. And they're basically the same thing. They are an election in the tax code. And so you either have to elect under section 1031 or 1400Z. You can't do both. Now,
Gotcha.
we've been able to fix some deals where somebody 1031 into a property that's in an opportunity zone, and we were able to ultimately make that an opportunity zone deal going forward. But you want to be real careful about it. And the key thing is that if you're going to be doing a deal in an opportunity zone, and it's really easy to find out where the opportunity zones are. There are 8,763 of them across the United States and the territories. Pretty much the whole island of Puerto Rico is an opportunity zone. There's some in St. Thomas, St. Croix. There's some in Guam, Hawaii, and each state got to designate up to 25% of its low-income census tracts. So there are opportunity zones in urban areas and rural areas, pretty much everywhere. If you go to ozpros.com/map, you can search to see where those zones are. And if you're going to be doing a deal in an opportunity zone, you're crazy not to at least look at if you can potentially do it as an OZ deal. Any kind of raw land is going to be an easy one to do, because all you have to do is just do some kind of improvement to it. If you're buying an existing building, you actually have to double the basis of the value of the building at the time that you buy it. Now, there's all kinds of nuances about how you can expand that. You can use solar. You can, if it's a Airbnb property, all of the furniture that you buy will count towards that. But there's some nuances that you got to deal with. And so, like buying a $1 million condo in an opportunity zone and trying to do that, that's probably not going to work. But if you can find something that's got some room for improvement, like on adjacent land, or it needs to be improved, it's a fixer-upper, or if you find something that's new construction that's in an opportunity zone, that will absolutely qualify if you take it before it's been put in service. And so when somebody does that, they avail themselves of this, benefit. And, once again, instead of just deferring capital gains, they're eliminating capital gains on the back end growth.
So back up 1 second on that, buy it before it's been put into service. If you bought something that's a spec build,
Yeah.
I'm just thinking that would qualify as far as the.
Absolutely. So we've set up captive funds for folks with Fourplex Investment Group, with a number of the track builders, right? That are building things in opportunity zones. People grab them before they are actually put in service. And put in service means that it hasn't been depreciated, it hasn't been rented, and it hasn't been made available for rent. And so we've got some documents that help you prove that. Because the great thing about opportunity zones is that you don't have to ask anyone for permission. That's one of the fantastic things about this program. So unlike 1031, where you got to run it through a qualified intermediary, or like new market tax credits, where you got to go get an allocation from a CDFI, you just do it. And then you file it on your taxes. And then you just need to make sure that you keep a really good audit trail. And if you do, then you're good to go and you can take the benefit of it. And so we've got people that are buying these things, they're buying them new, and then they're renting them out. So I've got a Airbnb down in Georgetown, South Carolina, that's on the water. This guy just got it built, and we've got investors that are coming into that and that are going to buy that. And they'll be able to have a waterfront house with a dock on deep water and a community pool. And that's an OZ deal.
Wow. No, I was amazed. I know out here in Oregon, a lot of the opportunity zones were actually in downtown Portland, which was like, it was based on census tract information, which
there's a great one
it,
in Bend, actually, too.
Yeah.
I got a bunch of clients that are doing deals in Bend.
Yeah.
I'll tell you what, we need you to talk to your senator, because he's not a fan of the program. And I don't understand why. I mean, I know that there's a risk for abuse, right? I mean, and unfortunately, when they passed it, they knocked off some of the guardrails. And so I get that there's big deals that are getting done that we're going to get done anyhow. And now they're getting a tax benefit. But I can personally attest to how many deals have gotten done, like literally hundreds of deals that would not have gotten done but for this incentive. And so I'd love to be able to sit down with Ron Wyden and walk him through all of the positive stuff that's happening and why this program needs to be, it can not just continued, but expanded.
Well, and let me ask you on that, one of the things that you mentioned with the, you don't have to ask permission kind of thing, unlike, like the 1031 where you have to go through a certain intermediary in order to qualify in it. This was an act passed by Congress.
Yep.
The idea was to incentivize investment in areas that needed investment. So who is the police, or is it typically the IRS and just you
IRS.
filing your taxes? Okay.
Yep. And so and they haven't said, and there's no like specific audit flag that this is going to create, but if you get audited, you just need to have the documentation to be able to tell the story that you did this correctly. And that's what we do. So we help people put that in place from the get-go, to structure their deals correctly, to make sure that they're thinking about their deals correctly, and then to make sure that they're actually building their audit trail story. And, it's funny because they did a survey, and most Americans would prefer to get mugged than to get audited by the IRS, like literally mugged at like knife point or gunpoint. And I'm like, that's crazy, right? The IRS is just there to make sure that you did what you said you did and that you've got backup to prove it. And if you've got the story to tell with documents to prove it, you're good to go. And so that's what we just continue to communicate people. Hey, listen, you can, and there's different nuances inside of the program, and we walk people through how to walk, firmly not in the gray area, but in the established area where they're not going to be in danger, and then just document it and you're going to be okay. And the IRS is not out there to get you. They're there to just make sure that you are doing what you said you did.
So what are some of the potential abuses for the program? I mean, if there's no rules, it's basically if there's a county that's been designated and you follow the guidelines, what is it that the potential abuse would be?
Yeah, I mean, so there could be plays where somebody's saying that they're doing an opportunity zone deal, and they may, I mean, one of the things that I've heard people ask a bunch is, hey, because inside of your qualified opportunity zone business, you can have 30% bad assets. And so they're like, all right, hey, listen, if I've got $7 million worth of opportunity zone property, can I go buy a $3 million condo in Manhattan and run that as one of my bad assets? And I'm like, that's substantial abuse, right? That's not good. And, or they're like, I'm going to buy, they're going to go and do something like that. And I think that that's where the IRS is going to be looking out, or where people aren't, they're not hitting the time deadlines, or it's funny because if you had a deal that was going to be in an opportunity zone deal that was going to happen anyhow, I don't think that that's abuse. I think that that's just being smart, and that's gonna be a benefit that you're gonna get. And there's nothing we can do about that.
Right. No, and as far as the opportunity zones, these are federal level, correct? I mean, as far as
So
they're passed by Congress, or is there anything comparable like on a state or local level?
yeah, so there's like the states, I know that different states have different economic development incentives that they've passed relative to like zones that they want to attract. And then a number of states have enacted additional kind of benefits if you're doing an opportunity zone deal. So Ohio's got an extra 10% tax credit if you do an opportunity zone deal. West Virginia gives you an abatement on your state taxes if you're a qualified opportunity zone business. Illinois is working on a dollar for dollar tax credit for any investment that you make into an opportunity zone. I don't know if that one's going to fly in Illinois or not, but and I know that New Jersey's got some extra tax credit incentives for like startup companies that are happening inside of opportunity zones. And there was a really big push to make kind of that extra credit, like that thing that pushed you over the edge for getting federal funding, that if you were an opportunity zone business, that you got special, you were kind of moved to the front of the stack, if you will. The other thing that was really significant about opportunity zones, like when they first came out, is that they became an inflection point. They became a pivot point to unite those local and state tax incentives with a federal approach. And so it was this perfect kind of confluence of state and local people getting together with national investors to try and bring these programs and these incentives together in order to do projects that probably would not have otherwise gotten done. And so it got local communities on the stick to say, hey, listen, what do we really need here? And, the lion's share of folks are like, man, we need housing in a big way. Okay, how can we take this program? How can we take this opportunity zone that we designated where we really need housing and we need stuff to pick up inside of there? How can we pre-approve projects for that? How can we tee this up so that we can make it easy for developers to come in with their opportunity zone dollars and do these deals? And we saw that happening across the country. Now, because, of the time, it's funny because I talked to a bunch of people and they're like, man, I thought that program expired. No, it hasn't expired. The two, the kind of rounding error benefits went away in 19 and 21, but the big benefit is still out there, and it's going to be out there until 2047. And, you got to have a gain by 2026. So we're timing out on that. And so people need to make sure that they're paying attention to it if they want to do this, that they get on the stick. But they've got all the way till 2047 to keep their deals. And hopefully the legislation goes through as well that'll extend out the program for at least 2 years. And then I think we could see a significant resurgence of interest and money that continues to flow into the program.
So let me ask you, you mentioned earlier other opportunities that people can get into beyond real estate. You mentioned solar. What are some of the other opportunities beyond the direct real estate?
That's the great thing about opportunity zones. It kind of also further differentiate it from 1031 is that you can go into any kind of operating business. And so if you're starting up a business that you think is going to massively grow, you're crazy not to do it in an opportunity zone, because all of that growth, right? If you got the next Facebook, you could take all of that growth and not pay any taxes on it. And there's not the $10 million limitation like there is in Section 1202, this qualified small business stock exemption. So that's a really, really powerful one. The other one is that there's other types of kind of real estate things that you can, and other incentives that you can stack on top of opportunity zones, LIHTC, solar. So there's between at least a 30% tax credit on doing solar deals. So we've got a lot of people that are doing green data centers. for the computing power that's needed for artificial intelligence. They're doing those inside of an opportunity zone. And so they're taking advantage of all of the credits that are available with that. And then they're stacking them with opportunity zones as well. We've got folks that are doing oil and gas. So, notwithstanding the fact that we're trying to go as green as we can, there's still a massive need for domestic production of energy. And there's, a whole tax code associated with oil and gas that allows for some really compelling benefits there, where you can effectively get depreciation back in the amount of your full investment year one. And so we've got a group that's doing an oil and gas deal where they're providing that exact benefit along with a 6% cash return and then, a 2x benefit on the back end. And so you get a 2x benefit on the back end with zero depreciation recapture and zero gains on it. And you're getting 6% along the way. I mean, it's like, holy cow, this is incredible. And so that's the really cool thing that's happening, is that people are getting really creative about other things that they can be doing inside of opportunity zones.
And to that, so an operating business, does that qualify?
Absolutely. So
Okay.
we've got people that are starting businesses. We got people, so business brokers. This is also a crucial thing for business brokers to be paying attention to, because I can help somebody save significant taxes on a sale that they've already got teed up. So I did M&A for 10 years. And that was one of the big things was, hey, I'm going to have this big tax bill when I sell. Well, we can mitigate that. And more often than not, they're going into something else. And so we show them, hey, listen, your next endeavor, let's structure that as an OZ deal, and then you won't pay any taxes on the growth of that over the next 10 years. But when somebody's buying a business, they can move it into the opportunity zone and they can get this same benefit as well. We did a bakery where it was an SBA deal and they acquired a bakery in the real estate, and we were able to successfully do that. We've done a fertilizer plant. We've done, the example was like a lawn care company. I've done a pool installation company. We got lots of operating businesses that we're helping. And, the possibilities are endless. I mean, I got a list of the different deals, bamboo farms. It's really cool to see kind of all the creative things that people are doing.
No, I think that's one of the things that I'm always amazed, when these opportunities come from the government. There's basically the language is created, and then it's left up to the citizens to figure out how to apply it, and then I
Exactly
guess
right.
and follow whatever the intent was. And if you're you want to always follow the rule kind of person, it's hard for you to understand how to navigate it. But if you're like well, what about this? What about that?
Sure.
If you can think outside the box, it really does expand the opportunities and to get creative and future benefit, not just for you, but the community. Going back to your do well by doing good
Sure.
kind of thing. So
That's what I love about America, is
yeah.
that we were born on that function of, all right, we're going to make this work, and we're going to, and that's how innovation was created. And, we still have that indomitable spirit. And I love seeing that at work with people that are saying, okay, I'm just kind of, and they hear about it and something sparks and they're like, hey, I think that I could utilize that to do X, Y, and Z. And so I get to do strategy calls. I mean, we've had almost 4,000 strategy calls since we've been doing this. And so I get to help people kind of conceptualize that and be like, yeah, you know what? I think that works. Or, hey, listen, yeah, I like that idea. Here's how we can kind of tweak it a little bit. And here's how we can absolutely make that work inside of this. And bam, here's how you can not only, create generational wealth for your family, but here's how you can actually positively impact the community and, make it so that you're actually making a difference. That's really cool.
Oh, that's awesome. Hey, one more question about this. Are most of the investments you're finding that are in the opportunity zones, are they done through a fund, or are there a lot of individuals?
So by very definition, you have to put your capital gains into a qualified opportunity fund. But like I said before, a qualified opportunity fund can be as simple as an LLC taxed as a partnership. So there are professionally managed funds that are out there, and you could put your capital gain into a fund like Crescent or Madison Capital or Origin or Arcturix. I mean, there's a bunch of them that are out there. Or if you want to, you could do your own deal. And that's what we specialize in doing, is setting up funds for people that want to do their own deals, either with their own capital gains, or they're like, yeah, I've got a couple of friends and family that I'm going to go raise money for, or, hey, I need to raise a $10 million fund. So like I'd say that we kind of tap out at like a 25 to $50 million fund. If you're going to do more than that, then we've got some, kind of bigger players that are doing the, all of the machineries that have to happen within a big fund like that. But we handle it all day long for, literally. And people are like, oh, what's the minimum threshold? And I'm like, how much money are you going to make? You could have literally $10 of capital gain. You start up a business that's the next Facebook, and bam, it's like, well, you're crazy if you didn't do that as an OZ deal. So it's all about what your gain is going to be. And generally in real estate, if you factor in like how much the cost is and like what the maintenance costs are going to be, if you're doing around a $350,000 deal, it absolutely makes sense from a tax mitigation standpoint to look at doing it as an OZ deal. If you're
Well,
under 350, probably not going to make sense.
yeah. No, I appreciate you kind of spelling that out, because I think that's a lot of what people, when they're looking from the outside, kind of I don't know if that fits me, or they think it's too big or needs to be a
Correct.
lot bigger
And
or
they're like,
something like
oh,
that.
it's got to go through a fund. Well,
Yeah,
a
yeah,
fund's just a term. It's a term of art. There are funds out there, and we've got deals. It's funny is that we've actually got deals that were put together by funds where they've got their own qualified opportunity zone business, and now they're actually coming to my custom created, captive fund holders to say, hey, listen, do you want to put some money from your fund into our deal? Because we haven't been able to finish out our raise. And that's been an interesting road as well. Kind of fun.
cool. Hey, Ashley, if we could, I'd like to shift gears here for a second. By day, I'm an insurance broker, and as such, I work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically consider. We first look to see if we can avoid the risk. If that's not an option, we look to see if we can minimize the risk. And if we cannot avoid nor minimize the risk, we look to see if we can transfer the risk. And that's what an insurance policy is. And as such, I like to ask my guests if they can look at their own situation, clients, investors, the legal environment, the Fed, whatever it is that you consider to be the biggest risk. And again, for clarification, while I'm an insurance broker, I'm not necessarily looking for an insurance-related answer. And so if you're willing, I'd like to ask you, Ashley Tison, what is the biggest risk?
Well, in the context of what we do, the biggest risk is audit, right? So inside of opportunity zones, right? That's the thing that would unwind your deal. So all of these plans that you've made, if you can't survive an audit, then you're going to do it all for naught. And so in stepping into that, there's a number of ways that you do. You try to avoid the risk, you try to mitigate it. And then, ultimately we're actually, and we need to talk with you about this, we're working on an insurance product for exactly that. That'll cover audit, actually covering the price of the audit. And then that will ultimately cover any kind of indemnity we'll have an indemnity threshold, but it'll cover up to an amount that the IRS said that you were incorrect on. And, the easiest way is, like I said before, is to just have a really solid and organized audit trail that reads like a book and that is presented in a storybook format. And, that's the best way to mitigate it. And then secondarily is to have good professionals who can assist you with processing the audit with the IRS. And then, ideally, we're going to be able to put together this, or try to figure out an insurance product that will then insure it. So great question. I love it. And I love the fact that you're posing that question to everybody, because everybody should be looking at that as it relates to every element of their life. How can they mitigate risk and how can they deal with it effectively? And that's both inside of opportunity zones. That's within their taxes as a whole. That's within their real estate deals. I would say even that it's within kind of life itself relative to family and business continuity, that they ought to have a plan in place in order to be able to address potential situations down the road where they may not have access to the infrastructure that's available today. And I think that that's awesome that you're encouraging your clients to think about that kind of stuff. That's what we do with Centurion, is we help people with kind of continuity plans.
I appreciate that. And definitely risk is everywhere. And if you're not thinking about it, it probably is going to get you. So having
And I
some
think
sort of
that
an
that's the
idea.
key, is that
Yeah,
you can't be scared of it, but you also can't ostrich it, right?
right.
So, and as as you really talk about it and as you develop a plan, it also then it gives you confidence to be able to walk into contact with whatever that risk is, knowing that that you've got a plan, and that, well, and we know, well, we were talking about Mike Tyson before the show, and like Mike Tyson said, everybody's got a plan until they get punched in the mouth, right? And so we know that that plan's going to potentially go to mess, but the fact that we've got a plan allows us to walk way more confidently.
Well said. Hey, Ashley, where can the listeners go if they'd like to learn more or connect with you?
Absolutely. So if they go to ozpros.com/podcast, we've got some special promotions for your listeners. So we've got a discounted strategy call. So if they want to get on the phone with me and they want to talk about OZs, they want to talk about anything that we talked about on the call, they can do that at ozpros.com/podcast. We've got our opportunity zone cheat sheet on there, which is basically opportunity zones on a page. We've also got a slideshow that I typically do like in a presentation, and then we've got access to our Osworks group communities and our Ascent community as well. So we'd love to talk with your listeners. We'd love to hear if you got questions. You can also, we've got a contact form where you can drop your information into there, and we'd love to connect with you. Final piece and final place that they can go is ozpros.com/YouTube. And we've got tons of videos out there about opportunity zones, about the cool things that are happening. I'm a big hunter, and so we've got like almost like a hunting show that's on there where we're showing people how they can do hunting, cool hunting tax mitigation inside of zones, fishing as well. And we'd love for people to check us out on YouTube and subscribe if they would as well. It helps out with the algorithm.
Awesome. Well, Ashley Tison, I cannot say thanks enough for taking the time to talk today. I've enjoyed it, learned a lot, and look forward to doing it again soon.
Yeah, absolutely, Darren. Thanks for having me on. It's an honor and a privilege.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.